Next, we have Mark Taucar. Mark manages discretionary clients through Excellent Select Discretionary Management. Mark has built discretionary referral platforms for notable portfolio managers across Canada and has engaged with referral agents for the construction of streamlined referral operations which enhance scalability, profitability, portfolio design, and compliance. He has also managed successful investment strategies on behalf of thousands of individual clients that include pensions. Mark is also a faculty member of the Knowledge Bureau. Ladies and gentlemen, Mark Taucar.
Thank you everyone for your participation in the DAC conference, and thank you to the Knowledge Bureau for having me speak at this year's conference. This is my third time at DAC. The other two times I was an attendee sitting in the same seats you're at right now. Not necessarily the same seats. We were in person for those DAC conferences, but I was an attendee for one, and I was a speaker for last year's DAC conference along with Jean-Pierre Laporte. And it goes without saying, but each year I've ever participated, I'm amazed at the quality of content and the ability to access top-level expertise. I hope you enjoy this conference as much as I do, and hopefully next year we'll all be able to travel together to DAC and be there in person. My presentation today will center around the aspects of behavioral finance in risk management. So as a portfolio manager with over 20 years of experience, both in buy-side and sell-side companies, I've had my share of experiences with the daily psychological implications of making investment decisions on behalf of large mutual funds, and then also on behalf of individual client accounts. This presentation is also a supplemental to the course that Knowledge Bureau has available for you called Portfolio Management in Retirement. So I encourage you that if you want to learn more about portfolio construction and management, that would be a course that you'd want to take a look at, where you would cover aspects of portfolio construction and management of portfolios. This year's presentation will be set against the backdrop of the volatility that we've all witnessed in the markets here in 2020 and the resulting impact of that volatility on client investment objectives and their decision making. Our focus will be to understand a little bit of what our clients are thinking and feeling about their investments and their prospects for a successful execution of their investment plan. In today's presentation, we'll cover topics like prospect theory, how that theory incorporates perceived utility and the resulting investor biases that can ensue when it concerns investment decision making. We'll also discuss risk and return in the markets and explore the historical return of the markets to better understand the potential for portfolio performance and volatility, which essentially is risk. And we'll also discuss a framework for engaging with your clients to better understand their requirements for investing and the risks that they are capable of assuming. What is behavioral finance? Well, it's really just the examination of how clients react to changes in their portfolio and how they form rules and execute those decision-making rules. It was primarily built off of the economic concept known as utility theory. In fact, at the time this concept or theory was being crafted, there really wasn't anything close to an economist at that time. And having economists really wasn't a big deal back in the 17 and 1600s. Utility theory was really the domain of philosophers and mathematicians. A few contributors to this theory that you might know are Daniel Bernoulli and Adam Smith. The theory just really focused on gauging perceived value or utility, or what we'd otherwise refer to as usefulness, of an additional unit of something. It assumed that people make rational decisions and try and avoid risk wherever possible. Later on, a duo named Kahneman and Tversky proposed something called prospect theory. This theory actually won Kahneman the Nobel Prize. And I implore you, or I suggest to you, that if you are in fact interested, I'd encourage you all to read Thinking Fast and Slow, which really kind of delves into the psychology and the biases that investors fall prey to. Before we really delve into prospect theory, we really kind of have to get a grasp of what utility theory is all about. It's a theory that focuses on the added satisfaction that one gets upon obtaining an additional unit of something. It could be anything, really. It could be something as simple as haircuts, to bricks, to massages, all the way to investment returns. And there really are two ways of understanding or measuring utility. There's what we call the cardinal approach, which really focuses on more the measurable utility of something. So it tries to quantify the objective utility of an additional unit of whatever we're looking at measuring. Then there's what we refer to as the ordinal approach, which isn't really measurable. It's more the psychological preference of having more versus having less. And also to the right of the slide here, you'll see what I'm sure you're all familiar with, which is the standard utility function for most things that we can consume. And this is classic economics 101. When you take economics in school, they teach you about utility, and essentially the basic understanding is that the more that you have, the less meaningful it is to you. That's the concept of diminishing marginal returns. So essentially, again, the more that you have of anything, the less utility there is in the next level of consuming it. Well, let's examine a little further utility theory and maybe set up an example to show you utility theory at work. So let's imagine, if you will, we were at the DAC conference in Niagara Falls. There's no COVID, and after the morning presentation, we all get to go out and maybe gamble a little bit. And so we're looking for a few games that we can play, and we come across someone who's got an absurd concept for a game. It's really just a coin flip, but it's a choice of a coin flip. So the choice is A, you don't flip the coin and you get $50. And then choice B is you do flip the coin, and heads you win $100 and tails you get nothing. Now, after a while, you'll probably ponder why would anyone want to create a casino game like this? You'd lose money all the time. But we quickly get to the point where most of us, and studies prove this out, most of us would actually select option A. Now, why is that? Well, most people will select the option that is deemed almost a free money, right? There's no risk in accepting the $50. There is some risk in the $100 or the nothing option, because you can walk away with $0. So what's the real difference between prospect theory and now utility theory? Well, prospect theory took utility theory a step further and asked the question, what would happen if we now add the potential for losses to accrue to the decision maker? This is where the idea or the term of loss aversion was coined. It was coined from the work that Kahneman and Tversky had done, and their theory being prospect theory. Also, another finding of this theory is that people don't always make rational decisions, and we'll explore this in the next slide. Many of the same fundamental concepts in utility theory are used in prospect theory, except that a new variable is now incorporated into our analysis, a person's reference point. As you can see below, the graph now has 4 quadrants. The top right quadrant looks exactly like our previous graph, where once we add the next incremental level of consumption, we have a diminishing utility. But not only that, we now have to contend with taking away a unit of something and what that experienced utility to the individual is. And that's the bottom left-hand side of the graph. Now, how can we best describe this? Well, one example that I'm sure every one of us has experienced is finding a $10 bill on the beach. We're just walking down the beach, lovely day, we look down, and here's this $10 bill floating around in the breeze. We tend to be fairly happy that we found the money, and that feeling tends to last for a short period of time, but it's nothing that lasts for the entire day. Now, think about the flip side to that. So we've all experienced that feeling of finding money laying on the street, that $10 bill. But now think back to when you actually lost money that you thought you had, that $10 bill that you were going to use to go out and buy an ice cream. Well, I don't know about you, but certainly when it comes to me, that tends to sting a little bit more and it lasts a little bit longer in my day. Another example of this relationship is the same coin flip example we talked about in the previous slide, but this time instead of getting an option of $50 of free money or a flip at a coin of double or nothing, you now must choose between A, paying $50, or B, choosing a coin flip where the odds are 50% you owe nothing or 50% you owe $100. Studies show that most people choose option B, even though the expected outcome of both events is losing $50. The chance of not paying anything has the investor or gambler more often than not take option B. Now, what's really important about this, keep this in mind as we speak about investors, and especially those who are later on in their lives who are dependent upon you trying to make up for a lack of savings and planning with higher rates of return and therefore higher risk. So as alluded to in the last slide, this concept just doesn't extend to coin flip games or finding and losing dollar bills. This concept also extends into how investors make decisions about investing in the stock market. Studies have shown that there is a bias built into looking at stocks. Stocks with high historical returns oftentimes are bid up more than what is justifiable because investors feel they would be, quote unquote, losing out on the opportunity more than simply allocating to just safer blue chip companies. And so, what does prospect theory really state? Well, it states that faced with a risky choice leading to gains, individuals are risk averse, meaning they were preferring certainty and lower expected returns. But faced with a risky choice leading to losses, individuals are risk seeking. So that means they're preferring solutions that lead to lower expected utility as long as it has the potential to avoid losses. And what is so pivotal to all of these decisions is the current frame of reference or the reference point before making that decision. And that was that point between the upper quadrant and the lower quadrant. Where do you start from when you make these decisions? All this has led to observable behaviors by investors over different periods of time, which now we can actually categorize into different investor biases. The first one here being herd behavior. Now we've all heard this before, no pun intended, but herd behavior is essentially when investors mimic the financial behaviors of the majority of the herd. It's the groupthink idea. Everyone else is investing in pot stocks, so I've got to invest in pot stocks. And there's a collective wisdom of the crowd. Everyone thinks the same thing, so everyone bids up a particular sector. The tech stocks in the early 2000s, late 1990s. The next one is what we call confirmation and hindsight bias. So investors are inclined to accept information to things that support their own preconceived ideas and opinions. I joke with my wife, and I sometimes don't call this confirmation bias, but spouse bias. There's the next one that's called hindsight bias. It's a tendency to see the past as being predictable and explainable. And so we build rules that, based upon our experiences of the past, where, hey, we invested in tech stocks before, it worked out for us, we're going to invest in tech stocks again. So the truth is, the information now and the information then could be completely different. And we are allowing ourselves to use a simple rule just based upon our hindsight to govern how we're going to invest in the future. The next one is overreaction and availability bias. So essentially, this one, investors overreact on news. I mean, how many times have we heard this where the markets have started to sell off and people pick up the phone and think, okay, I've got to get out. Well, getting out right now is not the right time. It could be an overreaction to something that might not necessarily have a major impact on the market long term. Availability bias is a part of overreaction when investors' decision-making process is strongly influenced by the events closest and most available to them. So the recent sell-off. And this is really important, especially in the context where someone comes to you and the markets have been doing very, very well beyond the expectation of, let's say, the long-term return. Now their expectation of you is that you will continue, and this is the norm. Well, that's not the norm. Next, we have what's called mental accounting. And mental accounting is the propensity to allocate money into specific bins. So when they come to you about their investments, they'll talk to you about their car money or their vacation money, when really what they should be discussing with you is the whole portfolio and how that needs to be managed. Additionally, we have what's called the narrative fallacy. So the narrative fallacy is just a theory that has investors believe in outcomes based upon incomplete evidence. An example here is the idea that if you flip a coin enough over and over and it's heads every time, that the next flip should probably be more, the percentage of the next flip coming up tails should be more than we'd otherwise think. Well, in fact, that's not true. At each flip of a coin, there's a 50% chance, a 50-50 chance that it's either heads or tails. The next bias here is what's referred to as anchoring. And we've all experienced this when, for example, we're dealing with clients who may face capital losses, and we're trying to get them to crystallize a capital loss. But most clients are fixated on trying to get back to the original adjusted cost basis so they don't experience that loss, even though that the prospects of the underlying company may have changed, and changed for the worse in the case where the stock may continue to fall. So that's what's referred to as anchoring. And of course, overconfidence. Investors become overconfident of their abilities when they are on the winning streak, right? And the ability to handpick selective stocks and beat the market and make huge tons of money are always going to sway investors in their decision-making process. And that's when, of course, they overestimate their ability to pick stock. It goes without saying that all discussions with clients when it comes to building portfolios and trying to establish what a rate of return should be should happen in the context of the market, and especially in the historical framework. However, it's just too simplistic to say, you know what, long-term returns like the S&P 500 has returned 10%. What does that really mean to a client? Some clients who come to us don't have the same time horizon as was used to calculate the 10% figure derived from the S&P 500. The next few slides here will look at what markets have really done, but in chunks of 1 year, 10-year, and 25-year rolling averages. A picture is worth 1,000 words. And so here I've graphed returns of the S&P 500. The jagged line you see is the 1-year number plotted, and you can tell it's very volatile. The purple line just beneath that is much smoother, and it represents the 10-year number. And lastly, I graphed the 25-year rolling average return, which is the green line. And I'll explain how I calculated these in the next few slides and why it's really important. Much like I did with the S&P 500, I did with the TSX, and the same is exactly true. We actually have even more extremes that play out on a yearly basis. So you'll see that the jagged line here, the jagged blue line, that's the one-year returns that are plotted. Now, if we're dealing with clients who are desperate for returns because of bad planning and have witnessed periods like those that are shaded here in the late 1990s and the run-up to 2008, we have to correct for their bias, which in this case would probably be hindsight bias, and that will affect also herd behavior. They've seen everyone else make money during these periods of time. And so their expectation of you will be to, with hindsight, look at the market and say everyone else has been able to make this amount of money, which could be, in certain instances in the late 1990s, returns in excess of 15 to 20 to 30% per year. And so the expectation of you is, well, you should be able to do that as well. This slide really describes the methodology and some of the metrics that we saw plotted out in the other two graphs. On the left side, you have the TSX. On the right side, the S&P 500. Now, all I really did is calculated a yearly rolling average of the returns with the data that I had provided. The TSX, I was able to go back to 1979. On a monthly basis, I had those data points. And on the S&P 500, I had yearly data points that went back to the year 1928. So how many one-year rolling averages do you have when you can go back to 1979 in the TSX? Well, here we had 485 one-year rolling averages. And out of that, 134 of those one-year rolling averages were negative. 351 were positive. The minimum or the greatest loss in those 485 rolling periods was almost 40%. The maximum gain here, 86.9%. Now you'll see a trend here as you go out further between 1 year, 5 year, 10 year, 20 year, and 25 year, you'll start to see that the rolling averages, their average returns, slowly start to get closer and closer to the compounded annual rate of return. And another thing that you see is that the volatility associated with the longer periods starts to diminish, so that there's less volatility to the downside. But, and this is why we want to talk about these slides, if by chance you have someone who comes to you who may only be 5 or 10 years away from retirement, yes, it's true to say that on average the stock exchange has returned 8 or 8.8 or 8.6% return, but there have actually been 5-year periods that, had you invested during those 5-year periods, you would have actually lost money. And this is why it's really important to speak with your clients about the returns in this type of framework. So knowing what we know about prospect theory and investor biases and what we've seen in terms of the market as it relates to 1-year rolling averages, 5-year, 10-year, and 20-year rolling averages, what has tended to be the outcome for most investors? Well, due to loss aversion, investors tend to feel the drops in portfolios more than they do the gains. And because of that, this leads to a lot of short-term, ill-advised decision-making. Short-term losses are always more probable than gains, and you can point to the two slides of the S&P 500 and the Toronto Stock Exchange, where the worst 1-year loss in the TSX was in the past 41 years was close to 40%, and that of the S&P 500 was actually approaching 45%. So those who are desperate to take chances to avoid the opportunity cost of a poor retirement or poor investment outcome, they'll be more prone to seek risk to avoid that perceived loss. The worst scenario here would be pre-retirees who haven't planned and are needing the long-term rate of return to be able to achieve a comfortable retirement. A group known as DALBAR has focused on trying to understand the psychology of investors and has released yearly reports on various aspects of why investors fail to meet their goals. As always, there is no surprise as to who the culprit is. It's the individual investor or decision maker that's to blame when it comes to failing to meet a certain return. Dalbar explored retention rates. Now, what they mean by retention rate really is how long do clients remain focused on a specific investment or philosophy that they're employing within their own portfolio. Now, over the past 20 years, investors have remained invested in their chosen mutual fund between 2 to 4 years. When markets are positive, it's closer to 4 years. When negative, it's closer to 2 years. Now remember back to that slide that I showed you of 1, 5, 10, and 20-year rolling averages. There were periods that had you invested, you may have not returned anything, or in fact actually lost money over 1 or 5 year periods. And in this instance here, we've just been told by Dalbar that most mutual fund investors really only invest for a 2 to 4 year time frame. Furthermore, Dalbar explored the returns that do-it-yourself investors using discount brokers generated versus their institutional counterparts. And here's what they found. Negative correlation between the access to information and returns for do-it-yourself investors. Now, all this really means is that the more control and the more information that do-it-yourself investors had, the more prone they were to trade on behalf of that information, and in fact the resulting return started to diminish. So as they got more control and more information and traded more often, the rate of return relative to institutional investors started to diminish. And of course, we can chalk this up to a couple of things, but not least of which being higher transaction costs because you're transacting more often, but overconfidence and availability bias. So let's take a look at a case study against the backdrop of what we've discussed. So how many times have you come across clients that look exactly like this? 60-year-old couple, they're pre-retirees. They're still working, but the time horizon's pretty short. $500,000 of investable assets, 5 years of work ahead of them, maybe 10 if they really have to. Earnings are $90,000 total. And I didn't list net worth, but let's assume that all they really own right now is just their family home, and it's about $500,000. Well, depending upon the standard of living that they want to achieve in their retirement, you may have a hard discussion with them to say, you're just not at the level in order to achieve a comfortable retirement. So prospect theory should already alert us against this client's mispricing of risks associated with investments. There is the potential that these clients will underprice the risk of the downside in the hopes of achieving a more comfortable retirement because of the desperation or the lost opportunity cost of a comfortable retirement. How do we protect ourselves and also protect our clients from themselves? Well, we have to establish a formal process of identifying the key drivers that would lead us to a certain asset allocation. These incorporate developing and understanding the qualitative and quantitative characteristics of the investor and their circumstances. The quantitative, well, what can we focus on in terms of quantitative data? Well, certainly the return objective. And as planners and wealth managers, we need to understand where the client is today as point A and where they need to go in the future, point B. And this happens in the context of the appropriate wealth management and financial planning or estate planning that you would do on behalf of your clients. The other quantitative, very objective point of information is the time horizon. How many years do we need to be able to achieve the desired point B outcome? We know when when it's that time where the accumulation phase needs to end, and now we have to draw down on the portfolio. There's only a finite time to create the returns necessary, and this is where the rolling average analysis is fundamental to our disclosure of risks to our client. Furthermore, we have to also explore what the current income stream is and for how long. If returns in the market drop off, can the client actually afford to buy in when stocks are cheap? Also, what is the current net worth and breakdown of those assets? The greater the net worth, the greater the capacity to assume the risk necessary to weather some of these drop downs. Well, the qualitative aspects of the client also shouldn't be discounted. And it's very important that when we build portfolios, we build them with what we refer to as the sleep factor, or what I refer to as the sleep factor of the client. You know, at what point would a client start losing sleep or start watching the markets daily? And at what point would they pick up the phone and say, you know what, I've had enough. It's time I throw in the towel. I can't take losses anymore. Once this return objective is established through our point A and point B planning, we now have a return amount necessary to achieve successful outcome. We need to understand risk tolerance, which is also going to be our next step. I see risk tolerance being decomposed into two main categories. There's what we call risk capacity, which uses the most objective quantifiable aspects of the investor's profile to ask the question, what is the worst case scenario and how will it affect standard of living in retirement? Our investors are 60 years old, have $500,000 to their name, and based on a 5-year time horizon, could face compounded returns that range anywhere between negative 11.5% and 28.8%. That's the worst and best 5-year rolling S&P 500 returns. And again, 5 years because at age 65, potentially, they're going to be retired. Well, what does that mean when it comes to what their end portfolio could potentially look like? Well, that means that they could potentially be invested in a portfolio that results in $271,000 as an end value, or $1.7 million as an end value. So as you can see, there's far too much uncertainty here and variability to allocate to a heavy equity portfolio. The next part of risk tolerance is what I refer to as risk willingness, which of course is the sleep factor assessment. And it's really the exploration of the client's view of the potential outcomes while understanding the probabilities of those outcomes. And it's best always to express these to the client as potential losses. Remember that clients feel the losses more than they do feel the gains. So this is imperative for us to be able to communicate what the potential losses could be with certain time horizons associated with their retirement or accumulation phase or saving up for education. And finally, what I refer to as risk need. The expert's opinion on how much prescribed risk needs to be included in the portfolio while balancing the variables of investment objective, risk capacity, and risk willingness. Ultimately, ladies and gentlemen, this is your expertise that comes to the table, your experience of having to deal with hundreds or thousands of clients and understanding what the impact of a short time horizon, the market over short periods of time can have on a client's portfolio. And again, this can be a very difficult discussion to have with clients, which is to say, in the case of our 60-year-old couple, what needs to be disclosed is there's no amount of investment performance I could bring to the table with a degree of certainty that's going to undo the lack of savings that you've got. So the ongoing management of portfolios, really what we need to be able to do is to take the emotion out of the decision-making process. Ideally, if we could all be Spock, emotionless and 100% logic-driven, we'd all be better portfolio managers. We'd all be better investors on behalf of our clients. But that's not possible. And so what we need to do is build in safeguards and pressure valves that will allow us to correct for our own biases. And so what does that mean? It means relying on quantitative investment management, where we can set targets for price of a stock where we want to sell and where we want to buy. And if achieved, we can't deviate from that. Factor-based investment management, where we can use, again, a quantitative approach to say, at this price-earnings ratio, we'll buy stock. At this price-earnings ratio, we'll sell stock. And again, stay within those guidelines. Limit any one position, stock, bond, or single issuer, to no more than 3% of the portfolio. Why is that? It's because we as human beings can't always be right. We don't have all of the objective information necessary to make decisions on behalf of buying and selling stocks so that we can bat 1,000. And because we can't bat 1,000, we have to build in these protection mechanisms so that when we do call it wrong, we haven't impaired the client's portfolio. We need to be able to diversify across all asset classes and regions. We need to set rebalancing rules that force reallocation back to a strategic asset allocation, and constant engagement with clients to address the concerns and continuously gather changing profile status. So what are the conclusions that we can establish? Well, the first thing is there's no amount of investment management performance that I can exact on a client portfolio to undo poor or late planning. If a client comes to me in terms of our case study here in that same scenario, the tough discussion will be, you may need to ratchet down your expectations for retirement. And of course, after this presentation, we all know that we are poor decision makers when it comes to our own investments. We suffer from biases, as do our clients. And what we need to be able to do is to develop systematic and quantitatively driven investment processes that can mitigate our own emotional and psychological decision-making rules, which we know cause us to underperform in the markets. Ladies and gentlemen, thank you very much. It was a pleasure to be able to present this to you. I welcome any of your questions, and I hope you enjoy the rest of the DAC conference.